What if I told you the biggest economic threat in 2026 isn't a crash, isn't a recession, and isn't some headline emergency? It's something quieter, something slower, a steady squeeze on your paycheck, your savings, and your financial future. The data coming out of Washington, from the Federal Reserve, the Congressional Budget Office, and the U.S. Census Bureau, is pointing toward a very specific scenario. Not collapse, not boom, but something in between. And that in between environment can quietly drain wealth. Economists are calling it a stagflation-lite environment. Not 1970s double digit inflation, but slower growth, rising fiscal pressure, and inflation that refuses to fully return to 2%. In January 2026, headline inflation cooled to around 2.4%. Sounds good, but the Fed's preferred measure, the PCE index, is projected by the Congressional Budget Office to average closer to 2.7% this year. That's above target. And when inflation runs even slightly above target year after year, your cash loses purchasing power. Quietly. First pressure point: trade policy. Recent tariff changes have reshaped global supply chains. While some measures were legally challenged, many tariffs remain in place. And tariffs are, in simple terms, taxes on imports. Studies from independent policy groups and analysts suggest current tariff structures could raise over $1 trillion in revenue over the next decade. But that revenue doesn't come from thin air. It flows from businesses and ultimately consumers. Some estimates suggest American households could feel hundreds of dollars in additional annual costs, depending on how trade policy evolves. That's not catastrophic, but it adds upward pressure to prices. And inflation doesn't need to spike to hurt you. It just needs to persist. That's the difference between a shock and a squeeze. Second pressure point: the labor market. According to U.S. Census data, net international migration fell sharply in 2025 compared to previous years. For several years, immigration was a key driver of labor force growth. Now that growth has slowed dramatically. A smaller labor force means fewer available workers in certain industries: construction, hospitality, manufacturing. At the same time, the Congressional Budget Office projects unemployment could tick toward 4.6% in 2026. That's not a crisis, but it signals cooling momentum. This creates a complicated environment: slower hiring, modest wage pressure in key sectors, slower overall growth. Not booming, not collapsing, just constrained. And constrained economies don't generate explosive opportunity. They generate caution. If you're finding this breakdown helpful, subscribe now. This channel focuses on data-driven economic trends, not hype, not politics, just what the numbers are actually saying. Because in this environment, understanding the trend early matters. Now the third force: federal spending. The Congressional Budget Office projects the federal deficit could reach roughly $1.9 trillion in fiscal year 2026. That's about 5 to 6% of GDP. For context, the 50-year average deficit is closer to 3 to 4%. Debt held by the public is projected to move above 100% of GDP and continue rising over the next decade. Here's why that matters. As debt rises, interest payments rise. The government is expected to spend around $1 trillion just servicing debt. That doesn't create productivity. It doesn't build infrastructure. It simply maintains existing obligations. And large structural deficits increase the risk that inflation remains sticky over time. not because anyone wants it, but because fiscal pressure limits flexibility, and that makes the Federal Reserve's job harder. Put all three forces together: persistent trade pressure, slower labor force growth, and elevated federal deficits. What do you get? Modest GDP growth, around 2% projections, unemployment drifting slightly higher, inflation hovering stubbornly above target. That combination doesn't destroy the economy, but it changes behavior. Businesses hesitate, consumers pull back, investors become defensive, and savers lose ground slowly. An inflation rate of 2.7% compounded over 5 years reduces purchasing power meaningfully. It doesn't feel dramatic month to month, but over time, it matters. So, what does this mean? It means cash sitting in low yield accounts gradually erodes. It means fixed rate debt becomes relatively cheaper in real terms. It means defensive sectors, consumer staples, healthcare, often outperform speculative assets in slower growth environments. It means being strategic matters more than being optimistic. This isn't fear. This is positioning. The U.S. economy isn't collapsing, but it is shifting. The loud crisis might not come, the quiet squeeze might. And historically, the quiet shifts are the ones that reshape wealth. The people who understand the environment early adapt early. And adaptation, not panic, is what protects wealth. If you want clear, data-backed economic analysis as 2026 unfolds, subscribe and turn on notifications. Because in this environment, information isn't optional. It's leverage.